Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront, and generate consistent returns year on year. So firstly, you want to open up any underlying. We've got UAL here. We have got a position and we are currently managing this position. But this is just UAL. You can open any underlying. We just want to see a list of expirations basically. And the expiration date that we want to pick, we want to see, obviously, the purpose of this is we want to see where we are in the option cycle, and we are trying to select an optimal expiration date. So we want to be between 30 and 60 days out in time. 45 days is ideal. And we also want to stick to the monthly expirations, not the weeklies. So the only expiration here that fits that criteria is December 20th. November 15th is too close. January 17th is too far. Everything in between is a weekly, so we don't want to touch those. So December 20th is where we're at, and that's 51 days out in time. So we can take that information, 51 days, come over to our watch list, and simply filter out any underlying that has earnings over the next 51 days. We do not want earnings to come along and mess up our position. Earnings will cause problems with our deltas. Earnings will also increase volatility, and both of these things will have a negative effect on your P&L. And we also want to filter out anything with a low liquidity rating level. We only want to trade liquid underlyings. We only want to be paying tight spreads, not wide spreads. So now we have a list of underlyings. I've got it listed from high to low IVR. You don't have to do that if you don't want to. But generally speaking, you want to look for positions on things with an IV rank of 50 or more. Sometimes 30 or more can be okay, but generally speaking, 50 or more is where you want to be. So we just want to go down the list and see what looks good to trade. You want to keep in mind what's already in your portfolio. Obviously, keep everything diverse. If you are heavy in any one thing, keep that in mind. And don't be heavy in any one thing, basically. Use your common sense. You can correlate things to the SPY. You can use beta weighting. But you can also just use common sense, and you'll be fine. So we go down the list, and the first thing that popped out to me is this here, Procter & Gamble, with an IV rank of 54.3, is trading at just under $167. It's got an absolute IV level of 16.9%, which isn't the highest. However, Procter & Gamble isn't something that really moves too much anyway, hence why with an IV level of 17%, we've got an IV rank of 54. So this will be something, this is, in your portfolio, it's important to have some juicier stuff and some more plain vanilla stuff, right? You don't want to have your entire portfolio full of Tesla and Tesla equivalent positions. Your P&L will not be smooth. You want to have a mix of, you know, for example, Procter & Gamble is a prime example. Coca-Cola is another one. There's loads of examples. You can use ETFs, right? All of these things will help to smooth out your P&L. You will make less money, but your P&L will be smoother. So by all means, go with the more daring stuff as well. But for your bread and butter, you also wanna make sure that you are, like I say, keeping it diverse. So we've got PG up, and we know we're already going to be at the December 20th expiration, so we can open that up. And now we can see the options chain here. We want to simply sell one call and one put. We want to sell them, anywhere between 15 and 20 delta. Because of the IV level, the expected move isn't that large. Therefore, our strike selection will suffer slightly. So we may have to be slightly flexible on this position, but that's okay. So normally you want to be between 15 and 20 deltas. So, but on this position, we're probably going to have to go with the 22 delta, which is perfectly fine at the 175 strike. And then on the put side, we can do the same thing here. We'll have to go with the 23 delta on the put side. And that brings us to creating this range here between the 160 and the 175 strike. Now, on this position, we would collect $259 upfront in premium. We've got a 65% probability of profit. And if we wanted to get out of this position at about 50% of max profit, we've got an 84% chance of that happening at some point over the lifetime of this trade. So very, very high probabilities. We collect a nice premium upfront, and our broker is going to require just under 2.7k or just a little over 2.6k in buying power. So this is almost a 10% return on capital for a naked position. That's pretty nice to see. It's Procter and Gamble, doesn't really move too much. Let's just have a look at the chart here. As we can see, it doesn't really do too much. We can see IV rank. Obviously, we've got these anomalies here. We can simply just filter out the high to give us a kind of cleaner, more accurate picture. So generally speaking, this is not a bad time to open a position here. Of course, it has volatility has been higher, or IV rank has been higher in the past, but that's fine. Even if we open this position now and volatility goes up a little bit and then comes down, it's fine. We've got 51 days on this position, so it's not a problem. And we will get just under $6 in daily theta decay. This number will increase, assuming all else is equal, as we get closer and closer to expiration. Now, if 2.6, 2.7k is a bit too much for you, by all means, you can just buy another contract, say the next strike down $5 wide, do the same thing on the put side. Now we've created a $5 wide spread. Our loss is no longer unlimited. It is now defined. Our loss is now defined by whatever the spread is. It's $5 minus the premium that we collect. So it's $5 minus $1.41, and that comes out to $3.59 times 100 shares, because there's 100 shares per contract. So that's a max loss of $359. Our broker knows this, so it's only going to require $359 in buying power. So if you notice here now, we've got a much higher return on capital, but we also do have a slightly lower probability of profit. So that is the trade-off, but that is how you can manipulate positions to fit inside any portfolio. How do you know how much buying power to allocate to any position, any given position? Well, we've got a position sizing template that's free for everyone to use. The way it works is you simply enter in the size of your portfolio, you then enter in what the current VIX level is, and below that, everything will then be automatically calculated for you. It will tell you exactly how much buying power you should allocate to any single undefined, defined risk position, how much of your portfolio you should allocate to short premium strategies in general. And as long as you follow this, you'll be fine over the long term. Link for this is in the description. It's free. Click on free position sizing template. It'll take you to where you need to go. If you do want to learn in more detail, link in description. Click on EDS Premium and get yourself signed up. Inside, you will have access to our portfolios where you can see the positions that we're placing live, how we're managing risk, the adjustments that we're making, etc. in real time. There's also a full course as well, so no prior knowledge is required. We'll teach you everything you need to know, and then you'll also be able to see it in action, live, happening in front of you every day, every week. So both of these two things will get you up to par. But if that's not enough, then there is also a private community as well. So you can speak directly with myself. I'm in the community every single day. Answer everybody's questions, and you can also speak with other like-minded individuals as well. We're all on the same journey. There's a 100% money back guarantee. So once you have studied our full course and followed our positions for at least 6 months, if at that point you don't know what you're doing or haven't seen results or aren't profitable, then we will work with you for free until you are, or until you do. And or you can simply just request a full refund. So it's completely risk-free on your part. Right now, it is £1 a month to join. The price will be increasing. However, once you're in, the price is locked in. You don't need to worry about price increases. You are rewarded for getting in early. Right now, we are also offering one-on-one complimentary onboarding calls with myself directly. So get in while you can, while the price is cheap, and we are offering complimentary onboarding calls. And with that being said, I will see you guys on the inside.